Good morning. You are watching a live daily market outlook for Thursday, 1st of March 2012, beginning of the week. The markets are attempting to recover in a way from yesterday's big movements after Bernanke's speech when he cautiously said that U.S. recovery is in a good path, but also hinted that possibly no more quantitative easing are in pipe for the near future. This actually triggered a huge slump in the markets as euro and commodities fell significantly lower while dollar appreciated across the board. The immediate reaction was as during the Asian session also the shares dropped during the overnight trading as Federal Reserve Chairman Ben Bernanke put the brakes on a recent rally by curbing optimism about the strength of the U.S. economic recovery, but without signaling any further monetary easing to stimulate growth. Also from China, official private sector factory data reminded the investors of the fragile state of the global economy, while suggesting Beijing could avoid a hard landing. The euro dipped as low as 133. That is approximately currently the current levels of the single currency against the US dollar, while sterling remained quite intact after yesterday's action, even rallying higher and posting fresh high, currently easing towards 159 support, which is the main support in the short term. Dollar yen appreciated above 81, our initial barrier, while dollar Swiss is also in recovery mode, breaking above 90.00 barrier and currently attempting through 90.50 overnight's high. Gold has registered significant losses yesterday after dipping off high at 1790, posted yesterday, dipping down to 1686.80 so far. This marks a 38.2% retracement of the entire move of 1522 low. While crude oil remains under pressure, but currently in the consolidating mode after hitting a fresh low at $104.83 per barrel in the late hours of yesterday. Also, full calendar for today that we are going to take a look now. Okay, some events have already been released. We are kicking with the Eurozone final manufacturing PMI that is due at 9 o'clock. GMT 49 is the forecast compared to the same value of the previous release. Then we have UK manufacturing PMI due at 9:30 GMT. A slight decrease, 51.9 is the forecast for today versus 52.1 of the previous. Eurozone CPI flash estimate yearly release is due at 10 o'clock, unchanged 2.6%, as well as unemployment data 10.4%. Today's forecast compared to the previous release. A number of speakers also. MPC, Bank of England MPC member Miles is due at 10 o'clock GMT, while FOMC member Pianalto is at 13:00 GMT. Americas start with the Canadian current account at 13:30 GMT. Minus 9.4 billion Canadian dollars is the gap is forecasted for today, narrower compared to the previous gap of previous month gap at minus 12.1 billion Canadian dollars. Canadian RMPI monthly is at 0.3 compared to minus 2.4 previous release, while Canadian IPPI monthly is 0.4, again better than the previous release at minus 0.7. US jobless claims weekly release is forecasted at 350, slightly below the 351 of the previous release, while US core PCI index monthly expected unchanged at 0.2%. US personal spending is expected to improve by 0.4% compared to the previous unchanged release, while the personal income is also expected to stay unchanged at 0.5%. Ben Bernanke is again due at 1500 GMT, when it's also due the US ISM manufacturing PMI, a slight improvement. 54.6 is today's forecast compared to 54.1 of the previous one. US construction spending 1.1%, lower than 1.5 of the previous release. And manufacturing prices improvement 57.6 today's forecast compared to 55.5 of the previous month. Some speakers are also due at 15:30 FOMC Raskin and FOMC Lockhart at 17:30 GMT today. Quick look now at the markets for the latest movements, starting with Euro. Seen on 4-hour chart that pair reversed nearly 38.2% of the entire move of 129.73 low of 16th of February, as upside the renewed attempt at 134.85 was capped, and the break of strong near-term strong support at 133.65.50, which is also the break point, and also marks 23.6% retracement, pushed the price lower. As we can see, the prices accelerated when yesterday's when Bernanke started its speech yesterday, and the break below the break point of 133.65.50 signals near-term double top here, as the pair extended initially to 133.13, and currently is 133.04, the low of the day, just ahead of 133.00 round figure support, and 132.89, 38.2% Fibonacci retracement. Studies on 4-hour and hour are negative still. We're holding well below their midlines. That sees potential of further weakness of the pair, but from the other side also corrective action might be seen. The overnight correction was mild, as bounce of last night low at 133.13 was limited at 133.55, just under 20 days exponential moving average on the hourly chart, with fresh weakness now underway. On the downside, we'll be looking for test of 132.90, which is also the previous high of 21st of February, and 38.2 Fibonacci retracement ahead of 50% retracement at 132.29, and strong support at 132 zone, higher platform of 21st, 22nd of February, below which opens 131.69, 61.8% Fibonacci retracement. On the upside, 20 days moving average at 133.52 currently is limiting the upside for now, along with the 133.50.65 previous strong supports now reverted to resistance. Only regain of 134 zone, where it's 55 days exponential moving average would improve the current structure and possibly refocus levels at 134.85. Daily structure holds still a positive tone, and the bulls of 126.22 low remain intact for now, as 20 days moving average breaks above 90 days and keeps the downside protected for now. There is also a 38.2 Fibonacci retracement of the entire up move from 126.22 to 134.85. Current dip is seen as corrective, as long as 132.40 zone holds the downside. On the upside, break above congestion at 134.85 to open way for a extension towards 135 round figure resistance, and the 135.47 high of 2nd of December 2012. British pound, as mentioned, stayed quite unharmed by yesterday's strong move of the dollar across the board, where the greenback gained against most of the currencies, and didn't register such a significant losses like euro. On contrary, the pair extended the gains to 159.91, fresh high ahead of current easing. As long as 159 support holds, this is a previous high of 24th of February, a low of yesterday, and overnight low at 159 zone, where is also 55 days exponential moving average. As long as this zone holds, immediate focus remains at the upside, and the current bullish action of higher platform at 158 zone remains intact, keeping the focus at the upside. The break above 159.91 opens our next resistance, round figures resistance at 160.00, ahead of 160.90, the high of 14th of this November 2011, where is also the channel, pardon, it's not 160.90 next, and 161.00, which is a 161.8 Fibonacci extension of the latest swing lower from 159.26 down to 156.50. Holding above also very important 200 days moving average at currently at 158.97, keeps the bullish structure on the daily chart intact, as studies are well above their midlines and still pointing higher. On the narrower time frames, as mentioned, the only loss of 158 higher platform would be harmful, whereas also 50 just above this is 55 days moving average. So loss of this zone would be harmful for a short-term bulls, and would put them on hold in favor of deeper reversal. Until then, the 159 offers now very good support, and while holding above this level, the focus remains at the upside. Dollar yen appreciated yesterday's strength of the dollar, breaking above 81.00, our initial target. Firstly, it cleared the initial resistance at 80.60.77 highs, and the break above 81.00 extended again so far to 81.39. Current corrective pullback is still seen corrective, as 1255 days exponential moving average at 80.77, along with the previous high, holds the downside, and keeping the possibility of further extension higher in play. A loss of 80.77, 80.60 would weaken the immediate structure, as the currently hourly studies are still in the positive territory. However, slightly pointing lower, that might signal a correction. Only loss of 80.24, 80.00 would weaken significantly the short-term structure and the signal possible extension of the corrective pullback of 81.65 high of 27th of February 2012, and possibly open way towards 79.50 and 79.00 post-intervention in October 2011 highs. Break above 81.39 is required to refocus 81.65 and turn focus higher towards next targets at 82.00 and 82.20. Positive daily studies see potential of further extension higher, but quite extended values on the MACD, and the momentum, as well as overbought conditions on the hourly, on the daily, warn of possible stronger reversal, and suggest more caution in the action with the dollar yen. Dollar Swiss is in the recovery mode after breaking 90.00, our initial barrier, extending initially to 90.50, followed by mild correction down to 90.19, just above initial support with previous resistance at 90 zone, as well as 20 days exponential moving average that contained the overnight corrective dip. A fresh rally through 90.50 has so far reached 90.56, looking for test of our next a significant resistance zone at 91.00, where it's also 50% reversal of the latest down move of 93.00 down to 89.29. A break above 90.00 also confirmed the near-term double bottom at 90.30 zone, as well as current attempt through 55 days exponential moving average on the 4-hour chart, setting scope for a further extension. MACD is currently attempting above, approaching the midline, and the break here to signal further extension higher, while momentum is quite stretched, holding above 100, but quite stretched at this point. RSI leaves still enough room for a further extension higher. On the upside, we need to see clear break above 91, possibly 91.50 in order to refocus our key short-term resistances at 92.50 and 93.00. Our daily structure remains still bearish, as studies are well below their midlines, and current bounce is seen corrective with also 20 days daily moving average at 91.03, expected to offer good resistance for now. Only break above 92.60, 93.00 would improve the short-term structure and possibly refocus levels at 95, 95, 70 previous highs of beginning of mid-January, 2012. On the downside, the loss of 89.30 support zone and double bottom would open way for further extension of the broader downtrend of 95.73, and the main focus will be on 200 days moving average and the Fibonacci expansion 61.8 at 87.70 zone. The yellow metal has registered strong losses yesterday after being unable to clearly break 1790 zone, the touch of 1790 above previous height 1787, with Bernanke's speech triggering a sharp fall, losing all relevant supports, even the higher platform at 1705. That was our initial strong support, and dipping down as low as 1686 in the late hours of yesterday. This turned the near-term studies into negative territory, but currently overstretched conditions on the 4-hour and also on hourly were already pointing higher. See scope for a corrective action that is currently underway with the 1725 seen so far, just ahead of 20 days moving average at 1727. We need to see the regain of previous range high at 1737, 1750 minimum in order to refocus upper levels. However, on the daily, the bullish structure hasn't been seriously damaged as the pair hit the bull channel support where the current reversal occurred, and this also marks 38.2 retracement of the entire move of 1522. This might keep also the upside still in focus, as the studies are still holding above their midlines, although pointing lower. As I said, the regain of 1737, 1750 is required to avert immediate downside risk, with break above 1763 previous high to refocus 1790, and our main targets at 1795 and 1802. Loss of 1686 overnight low risks further reversal, with the 200 days moving average currently at 1673, and then 50% reversal of entire move at 1656, below which would dampen the current bullish structure and possibly look to confirm the lower top at 1790 ahead of further weakness. The crude oil remains in defense of 109.92 high of 24th of October, traveling south during the whole week until today, as yesterday's fresh extension lower hit 104.83 low so far. On the daily, the wider picture remains still quite intact, as this reversal is minor, and as long as next very significant support at 104, 103 zone, previous range ceiling holds, the scope remains for a further extension higher, and the reclaim of 109.92, 110 our next target and psychological barrier. However, on the lower time frames, the outlook is still negative, as hourly studies are slightly below their midlines on current recovery, but 55 days moving average currently at 107.15 so far maintains the upside, and this congestion at 107, 107.50 zone needs to be cleared in order to signal temporary bottom at 104.83 and open way for a stronger recovery. A significant is break below the bullish channel on the hourly and 4-hour chart that weakens the structure on the lower time frames and keeps the focus at the downside, as studies are on 1 and 4 hour still in the negative territory. Break below 104.83, previous high of yesterday, is to open a fresh phase lower and possibly target levels towards 102.101 and a key psychological support at $100 per barrel. Important to mention that current situation with Iran keeps the pressure on the upside of crude oil, while fears of lower demand for the crude oil pushes the price higher. The NYMEX crude oil, as we see, it's going lower, while Brent is still appreciating based on concerns about Iran's dispute. I wish you a nice day.